Wanted to take a look at TLT stock today, which had a huge run up. As well, TMF stock, I'm going to kind of show a comparison chart on that as well. So we had two catalyst events, of course. Last week we had actually a few economic data points, but most notably the Federal Reserve meeting and then non-farm payrolls the very next day. Non-farm payrolls is showing us that the economy is slowing down somewhat. But when you actually look at the numbers, when you kind of lift the hood on this, you sit there and you realize that the headlines weren't really as off as they could be. And that's a huge cautionary because there are a lot of things going on within the economy, but payrolls themselves, unemployment isn't slowing nearly as much as the initial knee-jerk reaction would show. And I'll show you the charts as to why. Given that, with the Federal Reserve getting ready to start lowering interest rates, there are huge implications worldwide, and we've seen some bigger moves outside of what we saw in the stock market come Monday and this morning, Tuesday, that there are bigger moves in, say, the FX market, which will have ripple effects throughout the financial system worldwide. Let's jump in and I'll show you a few charts to kind of keep an eye on because they could start moving needles. Let's jump in. Here's a first look at non-farm payrolls. And really, this number wasn't extraordinary. It's slowing. We're seeing payrolls not be added as much as they had been recently. But if you look back just 3 months ago, we had 108 print. So this latest number wasn't really that extraordinary to really shift thinking in any kind of big way. But something I would look at, here's the look at these two numbers gives us the third number, which would be unemployment rate. So you have the civilian labor force, which is the blue. Then you have the employed civilian labor force in green. Now, if you look at these numbers, the blue has shot up. All right, this is July's numbers. What do we know about what just occurred? Graduations for universities just happened late May, early June, and so now they're starting to be counted within the employment sector. And as you can see, more individuals entered the civilian labor force, but the employed civilian labor remained flat. So the unemployment rate moving higher from 4.05% to 4.25%. It's actually, I think, 4.253. So it was 4.053 to 4.253. That was largely college students. Here is the unemployed civilian labor force, and basically what this is the total civilian labor force that I just showed you in the blue, less the green, the employed, giving us the unemployed civilian labor force. You take this number, you divide it by the blue from before the civilian labor force, and that of course gives us the unemployment rate. You'll notice that these two charts are fairly similar, but they're not 100% simply because it's a matter of where the total number employed of the civilian labor force giving us the unemployment rate. So this wasn't a huge catastrophe. We saw 3%, 3.5% sell off in the stock market on Monday alone. There was already a move lower from Friday that started on Thursday, which really started on Wednesday in the stock market. So I don't really look at this and I say to myself, wow, this is an economy that's coming to a screeching halt. I don't see that at all. I see an economy that is moving forward slightly less rapidly as before. So for those who are wondering about the stock market, that might be a buy on the dip opportunity for a short-term trade. But this is where I really boil all my analysis down. This is personal incomes versus personal expenditures. Anybody who's been following me for any length of time, I always divert straight to this. All right. As more and more people are added to the payrolls, we just had that being printed on Friday, those individuals will contribute to total personal income. You also get individuals getting a raise or getting demoted, however that works. Maybe they switch jobs and they're making less. Regardless, if you look at these numbers, they're roughly about 2.5%. This is below the median. All right. So we're not going to see an economy that's pushing very rapidly. But keep in mind, we're at 4.25%. This is an economy that's already running beyond what economists traditionally used to call full employment. We used to call 5%. If you can get below 5% unemployment rate, you were running at full capacity for the economy. And that's transitional jobs. Those are individuals who want jobs but just don't have one today. And to be counted on the civilian labor force, you have to be actively looking, wanting a job, but have been employed within a certain period of time. It might be 12 months, I can't remember, 18 months or something like that. After a certain period, if you don't get a job, they don't think you want a job, even though you might have something specialized, but those are very few people. So we're looking at an economy that is already firing at a very high rate of pace, but personal incomes and personal expenditures are not, even though we've kind of moved back upwards, are less than the median. So going forward, employment growth will be slow. Now, I still don't see 100% of the evidence necessary to say that the Federal Reserve, yes, absolutely has to lower interest rates given these numbers. Employment's a lagging indicator, and I don't think we're necessarily going to go negative anytime soon. We probably will October, November, December, maybe September as well, go below 100,000 new non-farm payroll jobs and then get closer and closer to zero growth. But it's zero growth in an economy that is moving very rapidly. And it's something that has to be balanced. But here's the other issue when you're looking at TLT stock, which is starting to fall back down from its spike from yesterday. Here's the other thing that's really important, that 70% of the inflation we just saw was from housing. Not from, yes, grocery stores and things like this, but when you look at the core, taking out energy prices such as oil and gasoline and food, looking at that core, you're looking at a housing price index that is still up 5.5% year over year. The Federal Reserve has to be looking at that as well as all the other data, saying, okay, employment's slowing down, but we still have housing prices year over year remaining lofty. And if mortgage rates continue to sort of trickle down, more and more people are going to enter back into the housing market, and that could drive prices back upward. That's a huge concern for the Federal Reserve because that was 70% of the inflation spike that we saw. Now, here is a look at, this is actually the Dow 30 in the bar chart. Then you have in the orangish is the S&P 500, then NASDAQ. And as you can see, going all the way back to February, we've pretty much wiped out everything. That the Dow and NASDAQ are sitting at their numbers from where they were back in beginning of March. And at this point, I did see that the market is starting to pop back upward right as I sat down to make this video. Those high-flying stocks, now here's one of the reasons why they've been pushed as much as they have up until then. Everybody's sitting there saying, well, the Federal Reserve is going to lower interest rates, therefore the economy is going to begin to expand. That's not the case, and I've been saying this for quite some time, that despite the fact that the Federal Reserve will be lowering interest rates, it's not going to necessarily be an accommodative stance to perpetuate an economy as much as they're eventually going to be in a rush to get the economy moving forward again, because it does dip. And I don't know that we're going to see a recession. I don't know that just yet. I do know that we are going to see growth rates in the economy that will be less than where they were before. Because of that, stocks sold off. But there are other factors you want to take a look at. In the meantime, here's your U.S. 10-year Treasury yield bonds starting to head back upward. May cross back into 4% territory because I think the market got ahead of itself. And I've been saying for over a year now that I do see a massive cleaning out of stocks. And I don't see that happening until October, November, December of this year, once we get the next quarter's earnings growth, where The reality is that individuals or savvy investors are going to sit there and say, wow, this economy really is not growing nearly as fast, and these stocks are overpriced. Sell. And boy, it's going to get ugly. Afterwards, because of the activity of the Federal Reserve taking time to work its way in, sometimes these interest rate moves take 3, 6, 9, 12, 18 months to work their way through into the economy and really have its efficacy. Next spring, the Federal Reserve, I believe, will be in a big rush to lower interest rates. In the meantime, here's a bigger look. This is the U.S. 10-year Treasury. Both these charts you're looking at are the U.S. 10-year Treasury yield. And I use the 10-year as the default because this is the measuring stick for all investments across the board. The 2-year is really sensitive to what the Federal Reserve does. The 30-year, of course, not nearly as much. The 10's a nice happy median right in between. As you can see, we're still pretty on in the bigger picture. We're obviously much lower than where we were in the 70s and 80s. I'm old enough to have lived during that period of time, and I could tell you inflation was out of control then. Inflation is high now, but not nearly as bad as it was back then. We will probably see the 10-year pushing back down between 2 and 3% at some point. And that'll probably be a year and a half from now till we see that. In the meantime, iShares 20 plus Treasury Bond ETF, TLT stock specifically. This is one that I have been getting involved in heavily back in April, and I think it was just April. I really started shifting, and you could see that sort of little mini dip prior to, I think we had another dip, I want to say like January, February. But I wasn't on board that was the time to buy. Sure enough, the market kind of fell back down. Then in April, I really pulled the trigger, and I pulled it hard for myself. Buying in at 87.5, 88, and 88.5. Have a tiny position at 90, not even worth bringing up. Obviously, at 97.37, I'm pretty happy. 99.99 was the high I saw printed yesterday for TLT stock. Let's take a comparison look at both TLT and TMF stock. So TMF stock is the same thing, but with a little more guacamole on top, if you will. It will move relative to TLT stock. TMF stock will move relative to TLT stock, which of course is the inverse to interest rates here in the United States. TMF stock will move relatively more. So anybody sitting on the TMF stock and looking for like a slingshot, you could see TMF stock is down 44% since 2000. Why this goes all the way back to 2011. So it's not exactly where you kind of want to start point, but I wanted to kind of give you an idea as to how this thing could move. I expect on a percentage basis that TMF stock will overtake TLT stock. I do expect TLT stock, which is sitting sub 100 right now, to go to 110. 110 probably. I've been kind of like daydreaming. Can we see 125? I think it'll take some time. For myself, anybody who does follow me knows that I trade a lot of options. I'll sell options out of the money to bring in premium. I do it all the time. Little positions here and there, just constantly bringing in money. When I believe that there's a move that may have gone too far, I tried to sell some calls yesterday, didn't get in. Because I felt that move was too much, too fast, and already it's down to 97.5. So what I'll end up probably doing now is selling puts at about 92.5 if I can get in there, with buy orders around that same price on TLT stock. TMF stock, of course, is priced a little differently, but will slingshot a little bit more. It might behoove me to go ahead and start stepping in and selling some options there as well. We'll see. But when it comes to TMF stock, I do believe we do see a movement higher. But there's something that I think everybody should kind of keep a look out on, and this is debt to GDP. This is a weekly chart going all the way back to 1975, and you can see how much damage the U.S. government has done to our potential future, burdening any children who aren't even being born because the birth rate is dropped. It's a pyramid scheme. You need more and more participants. Plain and simple. We're getting less and less participants, and they're going to have to pay more and more debt on a basis debt to GDP. We're running at 4% unemployment rate. This is way beyond full employment, and we can't even really meaningfully bring debt to GDP downward. Now, all through the world, everybody lines up to buy our debt. This will probably continue to be the case until it no longer is. And I'm not one of those hawks who says, oh, we're just going to be buried all the way into oblivion. People keep lining up to buy our debt. It's one of the safest investments out there worldwide. AAA sounds great. But as we shift, there is the opportunity that this keeps interest rates, the yields moving lower on pause, simply because they're going to have to find more and more customers to buy this debt. Too much supply, you got a lower price. That means yield goes higher. There's also another factor. Now, I started my career out in FX. This is dollar yen. And as you can see on it, this is a daily chart over the past couple weeks, probably about 10 days worth of trading here. There's been a very large shift out of dollar yen. All right. So here's how this works. If you're an FX trader, if you debt in or interest rates in Japan are incredibly low, basically zero. So you can basically borrow in Japan, deposit it somewhere here in the United States in the US dollar, and you get a differential. If you play the FX market, you don't even have to make the deposits. You just put the position on. And overnight, carrying your trade overnight, the carry trade that's where that comes from. You get paid anybody who's long yen dollar or short dollar yen. And as you can see over the past year, dollar yen has shot up significantly, and that has unraveled quite quickly because interest rates are shifting. But it isn't necessarily just dollar yen that's important. Here is the Australian dollar. Interest rates between Australian dollar and US dollar are also significant and play a key part. So as the US dollar may rally, what's happening is Australian dollar is selling off, but so is dollar yen. And what happens to that is Aussie yen falls quite a bit. Now, back in 2006, 2007, 2008, the carry trade was this enormous behemoth that got out of control. When it unraveled, this perpetuated a lot of the issues in the 2008 financial crisis. We will see shifts. Most of us won't even bat an eyelash, but you're going to see liquidity issues. You're going to see how these moves that we saw in, say, dollar yen and Aussie yen, and I also want to bring in, here's dollar yen again, and British pound. Pound yen, of course, has moved significantly as well. So this becomes a mathematical equation. The three charts you're looking at dollar yen in the bottom right corner, then British pound versus US dollar. The moves are accentuated with the British pound yen. So this will shift things going on within the markets overall. So it isn't, so the Federal Reserve, when they're looking at all these things, they aren't just sitting there saying, what's the employment rate? Oh, well, if it's there, then we need to lower interest rates. They're looking at everything. As well, anybody who's involved in the financial markets on any kind of basis should be looking at everything. A lot of us have other things to do, but this is something I continually gravitate because my history is FX. So looking at this, there will be ripple effects that the stock market is probably going to bounce. It's been bouncing this morning. Probably see it move up a little bit higher throughout the day, but we probably have printed the very high for some time. We're going to be continually getting more and more economic data, which suggests that the economy isn't growing nearly as much. Those overpriced stocks will be sold. In the meantime, the Federal Reserve very likely will not lower interest rates nearly as fast as the market wants it to, because the market's probably only looking at one or two things. You need to encompass everything. And the one thing I keep pointing to is the housing market. If mortgage rates move higher or lower, housing prices move back upward, which could be inflationary, and this could put the Federal Reserve in a really sticky situation. So for TLT and TMF stock, TLT stock is the one I'm playing the most. I do see a small bounce, dip lower, but then eventually, yes, I do see we cross the 100 level for TLT stock, and of course TMF stock will move reciprocally. Given that, beyond those, I am looking for 110 in TLT stock, and I'm also looking for the potential of, say, 115, 112.5, 115, 117.5. If we start to see 120, wow, we're seeing a really ugly economic situation. And I don't know that we necessarily get that far. Eventually, there are inverses to TLT stock and TMF stock, and I'm going to start talking about those that you should be kind of considering for your own portfolio once the Federal Reserve starts to raise interest rates back to a more accommodative position, or beyond an accommodative position into a neutral position. I don't think they're going to be able to get to neutral. I think they're going to have to go to accommodative really quickly in a few months. Make sure to hit that like and follow button for TLT stock, TMF stock, and of course, I do look at SPX at SPY stock as well. We'll see you in the next video.